Welcome to Canaccord Private Wealth. This is a monthly video designed to provide our investors with micro and macro insights from fund managers, both domestic and abroad. Today I'll be joined by Jonathan Talub from InvestSense, our independent asset consultant and a member of our investment committee. Jonathan, been a lot happening in global markets over the last couple of weeks since we've caught up. Specifically, I think what's relevant for our clients is Brexit, oil and the trade wars. So let's start with Brexit.
Okay.
What are your thoughts on that, and how should our clients be thinking about that relative to their portfolio?
Sure. So as you know, there's still a lot of uncertainty around Brexit and what's going to happen. So we're not going to speculate on the political side of things, but let's look at the possible implications. So number one is what markets have been focused on is the implications for UK market. And we will say from our point of view, there are probably going to be dire implications for UK if in a hard Brexit scenario, which is the worst case scenario and unfortunately the likeliest at this point. From our point of view, the UK is a relatively small part of an international equities exposure, which is itself is a part of a more large diversified portfolio. And we would access UK through managers, and they would have a good due diligence process to look at particular companies and the implications of Brexit on any company that they're holding. So I would say unlikely to have a massive impact on UK holding. I think what part of the market is missing is that the impact will probably be just as severe on the rest of Europe. UK is a big trade partner for Europe, so obviously a break in that trade relationship hurts the UK, it hurts Europe as well. The countries that are more likely to be impacted are, in that order, Germany, Netherlands, and Belgium. Germany obviously being the engine of Europe. So there's something to be looked at again. And here we have a larger exposure to Europe, again through a dedicated manager, in this case Platinum, that is obviously very well aware of that.
So similar to the Greek crisis of a couple of years ago, the Italians seem to be going down the same bowl. We've gone from souvlaki's to pasta. Should we be worried about that?
Yeah, no, that is a very worrying development because of the relative size of Italy versus the Greek problem, which was relatively small in terms of its impact on wider markets. Italy has been a big issuer of debt globally, which means that if they default on their debt, which is obviously a worst case scenario, that will have wide implications, not just for European banks, but for American banks and for a lot of, you'll see that pop up in a lot of other places. This is the Europe's economy number 3, and it's a big player in the world. So
do we have exposure to international bonds that may be covered by the Italian government that we should be concerned about?
Yeah, so that's a good question. My guess is not. When I say my guess is we don't have any dedicated exposure to European debt or to Italian debt specifically. We've met one manager in the portfolio, which is the T. Rowe Price Dynamic Global Bond Fund, which has a very active strategy of going in and out of various bond markets. To the best of my knowledge, at this stage, they don't have any Italian exposure, but obviously that could change.
Sure. Let's switch to oil. OPEC meeting on Thursday, the 6th of December, overseas. There's a lot of talk about Saudi Arabia going in and out. There's jostling for positions with the US. How is that relevant for clients?
Yeah, so what's relevant for clients is that we've seen the price of oil decline dramatically over the last few weeks, something close to 30% price decline. That is a big development, and it is worrying because often this is perceived to be as a sign of slower economic growth. So the thinking is, if the economy doesn't grow as fast or even goes into recession, there's going to be less demand for energy, less demand for oil. The oil market anticipates that, and the price of oil goes down dramatically, right? We don't believe that this is what's happening. We believe that quite simply the decline in price of oil is due to an oversupply. There's been too much supply coming to the markets. The market was anticipating that there was going to be less supply because of new sanctions on Iran, because of instability in Venezuela, and in Nigeria, and those things haven't really happened or haven't accelerated. So there's still a lot of supply coming from these countries to global markets, plus there's ramping up supply in Saudi Arabia, in Russia. So essentially just a glut of oil on the markets, which has caused the price to go down. And as you mentioned, OPEC is probably going to cut production, and over time you'll see that coming back.
So does that feed down into the power problems that we have, that all the political parties are jostling about here, and Mike Cannon-Brookes is starting a fair dinkum power campaign? Is that, can we align or correlate what's happening with OPEC with what's happening with mum and dad residents in Adelaide? Or is that too long a boat?
I think that's a bit far-fetched, but you will see definitely. I think where the commonality is around the geopolitical implication of what's happening in OPEC, and on to what you mentioned earlier around Brexit and what's happening in Europe, where essentially economic policies and what's happening in markets ends up having quite a big effect on mums and dads, and they express their protest usually through electing populist candidates, which is what happened in Italy, which is what happened to a certain extent in the US, and I think that's what you're mentioning, which we're starting to see happening in Australia as well.
Indeed we are. Speaking of populist elections, let's move to the trade wars, and President Trump and President Xi hugged it out at the G20 recently. We had a rally in markets globally. However, that's come off today, being the 5th of December. Where to from here?
Yeah. So I think like the sequence of event that you described is very emblematic of the type of volatility that we're seeing currently in markets. And it's something we highlighted, I think, in our last video, and we've been highlighting for the last 12 months, to be honest, which is that we're in a different market. Regimes changed. Nice and slow and easy is 2017. Today we're in a volatile market that's prone to those type of news, and it's prone to markets interpreting those news and extrapolating them into the future. So this is what we've seen happening with the trade wars since the beginning of the year, pretty much, was kind of that on and off. And I think Trump really playing that aspect of it, of I give you a little and I take it back, and I give you a little, I'll take it back, and that's part of his negotiation tactic. If you zoom out, what we have is really China is in a relatively weak position relative to the US. And the US knows that, and they're pressing their advantage. Why are they in such a weak position? The economy in China is not doing that well. And obviously that's not shown in the numbers that they publish. And
it's
I think
mandated to grow
exactly.
at 7%,
so that's not a secret to our viewers. But if you look through the data, there's good reasons to believe that they are coming close to even in a recession currently. So their economy is not growing, and probably in a recession. China needs access to capital coming from overseas. They're probably not seeing that coming as much as it has in the past, due to quantitative tightening or just lower liquidity conditions generally around the world. So they're in a relatively weak position. They probably have inflation starting to prop up internally. And that's just, they need that trade deal with America much more than America needs it. Yeah. So what you can expect to see is probably more volatility on that front. Whether there will be a deal or not, I cannot say. But if, and I'll leave you with that in terms of what clients should be looking at in terms of uncertainty in markets going in 2019. I think what's happening in the US, specifically at the Federal Reserve, and the interest rate setting policy, that will have massive effects on markets. And the other big thing will be what's happening internally in China and the ramifications for world economy.
It feels as though that the invisible hand is being guided by fear rather than fundamentals. So from a portfolio perspective, and getting back to the grassroots of diversification and the benefits of that, how is our portfolio positioned to overcome the white noise, which sells newspapers, and it involves Brexit, it involves oil, and it involves the trade wars. The correlation between those three topics of fear with good portfolio management and diversification and our holdings specifically.
And look, this might sound counterintuitive, but I think this is actually a healthier market environment. So to characterize a little bit, you have two types of environment: bull market and bear market. In a bull market, good news is good news, bad news is good news. And it doesn't matter what you do, market shrugs off the bad news and keeps going up. Indeed. And that's what we've seen 2016, 2017, and more largely in post-GFC period up until 2018. I think we're in a different market environment today, where the market is a lot less complacent. and taking news at face value. And I think that that's much better for us. It means that we have identified certain risks. We have positioned the portfolio defensively. And I think contrary to what happened in 2017, those things are starting to play out and we're positioned for them.
So maintain process, maintain structure, maintain discipline, and diversification with a time frame.
Absolutely,
over the journey.
Absolutely, and keep in mind that the volatility that we describe means at some point things might go against us for a brief period of time, and the important thing, as you say, is not to lose focus of the end goal, and to remember that we are in a more volatile and more difficult market environment.
Terrific, Jonathan. Thanks very much.
My pleasure.